You're listening to The Wealth Advocates with finance experts John Mickelson and Patrick Jenkins. The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Welcome, Wealth Advocates Nation. We sure enjoy having you with us for our second and probably one of our most crucial podcasts that we'll do in a long time. We're fortunate today to have with us Robert Spendlove. Robert Spendlove has visited with us 3 times previously, and his timing is impeccable right now as we deal with some of the most changing economic situations in our stock market, in our state. Robert comes to us with some specific knowledge. Some of his background is he was previously economic director to the state of Utah, to the governor's office. He's an adjunct professor at U of U on public policy. He's a representative in District 49, representing the city of Sandy, and he presently is the economic and public policy officer at Zions Bank. Robert, thanks for joining us today.
Thanks so much for having me. It's great to be with you. It's a little bit of a unique circumstance with the changes in our kind of our overall lifestyle. We're adjusting to a new normal, and but it's good that we can still have a way to reach out to people and be able to give all of you information. So what I want to talk about today is just kind of going through what we're seeing with the economy, the changes that we're seeing, the adjustments. We're still, I think it's really important to say, we're still really early in this process. It's only been a few weeks since we've started to see the economic impacts. There's a few different sides of the situation that we're in right now. The focus right now is primarily on the public health crisis, and so that we've essentially had most of the country encourage people to stay home, encourage people to socially distance, to not move forward in the way that they've done in the past, and the hope of that is to really slow down the spread of the virus. We don't know exactly how long that's going to last. Right now, it's essentially a rolling 2-week period, and hoping to restart things as soon as possible. But at the same time, we don't know if those 2 weeks turn into 2 months, like it did in China, or like it may have to in other parts of the country. And so we're just starting to see the economic impacts now, the results of some of those actions. And so that's one of the really hard parts is in economics, we're always working with data in the past. And whether that past is 1 day or whether that past is a month, or on GDP, generally, we're looking at data that's 6 months ago or several months ago. We're looking at our most current data right now is for the 4th quarter of 2019. And so what I'm going to include in this presentation is looking at how things were a month ago compared to how they are today. And that's probably the kind of a way to have that comparison. And a lot of the data from a month ago is hard data, but the data that we're looking at right now, because we don't have a lot of hard data, we kind of have to look at surveys. We have to look at indicators of what the economy is doing. So let's just talk about specifically what is the economic impact that we're seeing from the coronavirus, or COVID-19 as they call it. A month ago, we saw equity markets were actually reaching new highs, approaching 30,000 in the Dow. Equity markets had been really on a run for several years. We had down periods, of course. If you look at the period of December of 2018, what's interesting about this is the reason in the slide that is showing the Dow Jones Industrial Average, we saw a big drop from in the latter parts of 2018, and that was caused by the Fed essentially committing to continue to raise interest rates going into 2019. If you remember, the Fed raised interest rates 4 times in 2018 and said they were going to raise them another 3 times, in 2019. And the markets although they thought the economy was strong, they didn't think it was as strong as the Fed was indicating. And so that's why we saw that drop. But then through most of 2019, we saw a really strong rally in equity markets, the Dow going from about 22,000 to about 30,000. How does it look since then? In the next slide, we're looking at a dramatic drop in equity markets, really just over the last couple weeks, dropping as of today about 37% from their highs. Now, keep in mind that those highs are very high. We have essentially returned to the levels that we were seeing in around 2017 and 2018. So we had a big run up heading into our current market, but now most of those big gains have been erased. We've passed through the level of being a correction, which is defined as a 10% drop from recent highs, and we've passed below the level that would define a bear market, which is a 20% drop from recent highs. And at least now, one of the things I'm watching really closely is signs that we may have bottomed. We're not seeing that yet. A lot of it, markets are really driven by expectations of future economic activity. And markets don't have the certainty that they want to have right now. And so we're seeing some volatility. And I'll get into that a little bit in a minute when I start talking about federal actions and federal responses to the pandemic. When we look at consumer confidence, heading into this, so again, a month ago, consumers felt very confident in the strength of the economy, and this was reflected in a lot of data. So the green line of the graph essentially is drawn at 110. So this comes from the Conference Board, and above 110, consumers feel like the economy is prosperous. In February of 2020, that number came in at 130.7. So consumers felt very good about the economy. They felt very good about economic prospects and where the economy was going. And it had stayed at that high level for several years. You can see that in 2017, that consumer confidence number was about 125, and we'd been as high as 135. So we were kind of right in that range that consumers felt really good about how the economy was operating. For the next one, we have to look at, so this is another one of those numbers that is a backward indicator. We haven't gotten a new number for consumer confidence yet. But there's an organization called Morning Consult, which does a daily tracker. This is what the Federal Reserve has been watching. They do a daily tracker of consumer confidence. And you can see that daily tracking of consumer confidence has dropped very dramatically. From their scale shows it dropping from about 116 a couple of weeks ago until now we're down around 94 to 96 in their gauge. They've only been collecting this data. The data in this chart goes back a couple years, and that's about as long as they've been collecting it. So it's the lowest they've seen. So we have seen a dramatic drop in consumer confidence over the last few weeks. Again, that's another one that I'm going to be watching really closely to see when that bottoms. But right now, we continue to see that consumer confidence going down. Looking at kind of our economic fundamentals, another one is the unemployment rate. In January of 2020, we saw our unemployment rate at a 50-year low. 3.6% was essentially the lowest we've seen since December of 1969. Extremely low unemployment. It's interesting. Just a few months ago, we were talking about the struggles of labor shortages, the struggles of employers trying to find qualified employees. And it was something that the economy, frankly, was struggling with quite a bit. But one of the things that we see, and if you look closely at the chart, we drop below that level. So full employment is generally defined. Full employment is the level where employers can find the employees they need, but also individuals can find jobs. And that level is right around 4.5 to 5%. And we're heading into this, we were much below that at 3.6%. Our biggest problem was those labor shortages that I mentioned. But you can also see there's a close tie between unemployment, especially a change in unemployment, and recession. So every time our country has gone from a very low unemployment and it starts going up, it usually coincides with the recession. So that if we start, well, not when, but when we start to see unemployment go up, it'll be one of those signs that that we're entering a recessionary period. Now, what does it look like now? Again, we usually get this data on a monthly basis. And so we have to go to a different indicator of the overall employment growth, which is the claims for initial jobless numbers or unemployment insurance claims. And again, even this data is a little bit dated. This comes out every Thursday. Every Thursday, the Labor Department releases this. So a lot of it is somewhat anecdotal, but we have seen in the last week a jump in those unemployment insurance claims. To give a perspective, the state of Utah generally sees about 8,000 unemployment insurance claims a month. We saw 8,000 unemployment insurance claims the last week. So we've seen some big increases, and I've heard even bigger numbers coming out of other states that their UI claims are 3, 4, 5, even 10 times as large on a weekly basis than they generally are on a monthly basis. So that's something I'm going to be watching really closely as an early indicator of how the labor market is being impacted. Of course, it's going to have a huge impact. The response by the government has been right now focused entirely on, or I shouldn't say entirely, has been mostly focused on public health. And so what the response to that has been to tell people, cancel schools, close down bars and restaurants, close down entertainment, close down travel and tourism. And that is going to have a huge impact on a lot of small businesses. How do those small businesses react is the big question. And there will be businesses, well, there already are businesses that are having to lay off their employees. And those employees are going to start joining those roles of those receiving unemployment insurance. And so we're going to be watching that. The hope is that if we can restart the economy as quickly as possible, that we will be able to reemploy those people and bring them back into the workforce. But right now we just don't know because we're so early in the process and we don't know exactly what to expect with the virus. So looking at a survey of, now we've gone from kind of looking back a month to looking back a week, and now we're looking at a survey from the Wall Street Journal of Economists of what they expect to happen going forward. And in the slide on the top, on the left, you see is the expectation for second quarter of 2020, then moving down for the third quarter of 2020, and then on the bottom is the fourth quarter of 2020. And expectations, they're divided into essentially pessimistic forecasts, baseline forecasts, and optimistic forecasts. So essentially all economists surveyed by the Wall Street Journal think in an optimistic scenario, unemployment raises up to 4.5%, which would be right around that level of the full employment rate. The baseline scenario sees more of a more dramatic increase in unemployment, going up to 5.3% in second quarter of 2020, then dropping down to 5.1%, but then actually potentially going back up again to 5.5% in the fourth quarter as businesses struggle to get restarted and things start to shift. The pessimistic scenario is much more dire. Second quarter rising as much as 6.3%, which then turns into 7% in the third quarter and 7.4% in the fourth quarter of 2020. To put this in perspective, during the Great Recession, the unemployment rate was about 10%. And this is an area that there's a little bit of debate among economists. Some people are saying that the numbers could even be higher than the pessimistic scenario, but we just don't have enough information right now to know for sure. Once we get those rolling unemployment insurance claims, we'll know a lot more about forecasting where we're going to end up. Looking at total monthly change in jobs, again, we entered this period in a very strong position. The U.S. had the longest economic expansion in its history. In fact, technically, we're still in the longest expansion in U.S. history until we get the new data. 114 consecutive months of job creation. The U.S. job market just continued to move along every single month. But to put it in perspective, kind of what some people are expecting or envision that could happen, during the Great Recession, if you go back to 2009, 8, 9, and 10, we had about 6 months where the U.S. economy was contracting or losing over 700,000 jobs a month. And this is essentially what we economists often refer to as a V-shaped recovery. We dropped quickly, spent a little bit of time at the bottom, and then recovered relatively quickly as well, and came out of that recession. Now, one of the struggles with the Great Recession is, and you can see this with the monthly job growth during the expansion, we had consistent job growth, but it still did take about 10 years for us to fully pull out of the impacts of the Great Recession. The dynamics this time are different, though. The fundamentals of the economy were stronger. The financial sector is much stronger than it was heading into the Great Recession. But also the impacts could be much more dramatic too. We've never experienced in any of our lifetimes what we're seeing right now in the economy. So what do economists expect going forward? Again, back to the Wall Street Journal survey from last week. The optimistic scenario for the second quarter is to lose 200,000 jobs a month. Going to adding 15,000 jobs a month in the third quarter, and back to adding 175,000 jobs in the fourth quarter. Baseline scenario is to lose 500,000 jobs a month in the second quarter, then to lose another 75,000 jobs a month in the third quarter, and then adding 125,000 jobs a month in the fourth quarter. The pessimistic scenario is essentially assuming that we see a similar situation to the Great Recession in 2008 and 9, which is we lose about 800,000 jobs a month in the second quarter, and then continue to lose about 300,000 jobs a month in the third quarter, and then continue to lose another 40,000 jobs a month in the fourth quarter. So the pessimistic scenario, rather than a V-shaped recovery like we saw with the Great Recession, is more of a U-shaped recovery where it takes longer to unwind the negative impacts of the recession. When we look at gross domestic product, so GDP is the broadest measure of economic health that we have. It's the value of all goods and services produced in the economy. And the GDP had been very strong leading into this. Our fourth quarter was 2.1%. Now, it's not as strong as we wanted it to be. The goal was for GDP to be about 3 to 4%. But our economy continued to grow, continued to see consistent growth going into 2020, and going into even just a few weeks ago. So again, a good baseline economy working into the current situation. What do we see going forward? And this is where you start to see a big divergence among economists. The optimistic scenario is for a contraction of 4% in gross domestic product in the second quarter. And then a quick reversal to 1.7% growth in the third quarter and 3.1% growth in the fourth quarter. So higher than what we were seeing last year. Baseline scenario is a contraction of about 7% in GDP in the second quarter. Essentially no growth in the third quarter, and then growing by 2.6% into the fourth quarter. And the pessimistic scenario sees a dramatic contraction in the economy, dropping as much as 10% in the second quarter, followed by another contraction in the third quarter and more contraction going into the fourth quarter. Now, in terms of how do we define a recession is technically defined as 2 consecutive quarters of negative GDP growth. So the pessimistic scenario among economists surveyed by the Wall Street Journal is that we enter into a recession experiencing those 2 quarters of contraction. Some people think that contraction could continue as long as even the first quarter of 2021. But most economists think that we'll be able to pull out of that probably by the fourth quarter of 2020. To look at the impact of the current situation. So we don't know how much the self-quarantines and closing down businesses and closing down parts of the economy will have an impact. But here are the estimates of what it could cause to the economy. So again, according to the Wall Street Journal, if 50% of the economy shuts down, how does it impact GDP? And that's what this slide is showing. Essentially, for every week that we lose 50% of that economic activity, it causes GDP to contract by 1%. So after 1 week, it drops by 1%. After 2 weeks, it drops by 2 weeks. By 2 months, the economy is dropping 7 to 8%. And so that's if you look at kind of those probable scenarios, right now we've essentially imposed a nationwide shutdown for 2 weeks. So we're going to, there's a high probability that we'll see that 2% contraction. If it goes into that 2-month scenario, then it goes into a more dramatic slowdown. And if we have to go beyond that, that probability gets even worse. Looking at, again, because we don't have a lot of data, so this is looking at indicators of economic activity. China's been through this, and so looking at a few different areas to show how the economy of China has reacted. Their roads have essentially emptied and have not come back to how they were before. So economic activity has dropped there. Passenger flows in their public transportation system continue to be down and haven't returned to where they were before. The bottom chart is showing visits into Hong Kong. This was before there was essentially the imposed restriction on international travel. That had already essentially gone to zero or near to zero. And so if you kind of think about the impacts of all these, they can indicate how quickly an area can slow. Just kind of zooming in on that Chinese traffic. And we're just starting to get some of this data in the U.S., but those traffic flows continue to be down, even though China is trying to get back to work. And that's one of the struggles, is the longer an economy is shut down, the harder it is to restart it. And there's also a little bit of a struggle comparing the U.S. to China. China, even though China is still not up to where they were before, China is starting to return back to normal. And the thought is, well, the U.S. will see a similar case to China. The hard part of comparing the U.S. to China is most businesses in America are privately owned. In fact, almost all businesses in America are privately owned. On the other hand, almost all businesses in China are government owned or government supported or government subsidized. And so the government has a much more active role in the private sector in China, in the overall economy, and so they can force actions that is more difficult for the U.S. government to do. But what has the government done in in the United States? There have been essentially 2 ways that the government has very aggressively addressed this problem and the current economic situation. One is in the area of monetary policy, and the other one is in fiscal policy. And this is another very quickly moving target. This changes for sure daily and almost hourly. So what we know right now is that the Fed has, as of last week, it seems like 2 years ago, but last week the Fed aggressively cut interest rates to zero. The last time the Fed did that was in response to the Great Recession. From 2007, the Fed cut their Fed funds rate from 5% all the way down to zero. Now, to put this in perspective, the Fed doesn't control all interest rates. They only control the very short-term interest rates, which is what they call the federal funds rate. But that's a way to spur overall economic growth and to encourage interest rates throughout the system to drop as well. So this is one of the tools that the Fed has, and they have pretty much gone as aggressive as they ever have. There is a debate about whether the Fed will actually go negative in interest rates. They've gone negative in Europe before the current crisis. The the European Central Bank and the Japanese Central Bank had both moved into negative territory on their interest rates. I think the Fed will only look at negative interest rates as a very, very last resort to dealing with this situation. Just recently on 60 Minutes, Neil Kashkari, one of the Fed governors, said they are not inclined to go negative on interest rates. It can have really destructive impacts on overall financial markets. However, the Fed is essentially used up that tool now, unless they go negative, and it doesn't have the impact that it's had in past economic cycles. So in 1989 to 1992, the Fed dropped their Fed funds rate by 7%. From 2000 to 2003, they dropped it by 5.8%. And from 2006 to 12, they dropped it by 5%. This time, the Fed was only able to drop interest rates by about 3%. So now the Fed is having to pull in other of their tools from their toolbox, some of the tools that we've never even seen before or seen used this aggressively as before. The Federal Reserve announced, so they call it, the Federal Reserve calls it quantitative easing, where the Fed literally just kind of goes on the open market and starts buying bonds, mostly Treasury securities and mortgage-backed securities. A week ago, the Fed said that they would spend $700 billion to buy bonds, about $500 in Treasury securities and $200 billion in mortgage-backed securities. Overnight, last night, the Fed saw increased weakness in the markets, and they said, we're taking the caps off. We're going to spend as much as we need to make sure that liquidity is maintained and markets are supported. So that is, like I said, that is historic. The Fed is using every tool that they have to help support markets and help maintain liquidity. They've also announced a new program, essentially a Main Street loan program, where the Fed will help loan another several $100 billion to small and middle-sized businesses to keep them going and to keep them their finances flowing. So the Fed is using every tool they have. They've been very aggressive, very quick to try to address the situation, and they've had big impacts. So on the other side, though, the question is, what is this going to do to interest rates? There is a fear that, and this is one of the things that happens when Federal Reserve, Ben Bernanke, a former chair of the Fed, used to say that in bad economic times, it's best to just go up in a helicopter and drop money. So everyone started calling him Helicopter Ben. But one of the fears of this, or one of the problems, is that it will all this new money flowing into the economy will cause inflation. And so, and that's always been one of the long-term struggles of adding all this cash into the economy. So if we look at the interest rates, though, if we look at inflation, inflation for several years has been much below the Fed's goal. So the Fed has essentially a dual mandate. Their mandate is number one, to get at that full employment level, and number two, to maintain low and stable inflation. Their specific goal is 2% inflation. And while we had a brief period in 2018 where we saw inflation above the Fed's 2% goal, for most of the last 10 years, and even within the last few months, inflation has been much lower than the Fed wanted, coming in around 1.5% for the past several months. So at least right now, inflation is not a concern. If we look at things, indicators of inflation, housing market is not. We're not going to see inflation in the housing market in the coming few months. The oil market, we're seeing big deflationary pressure in the oil market as well. Some of the drivers of inflation are not showing any signs, so I don't think we have anything to worry about with inflation. The other side that, and I don't have a slide on this just because it's changed so quickly as recently as today, is the fiscal response. So there's monetary response and fiscal response. And this is where, frankly, we need Congress to stand up and start acting. The Congress is debating right now a $2 trillion fiscal stimulus bill that would essentially just inject money, more strategically into the economy. So the Fed has a hard time specifically injecting money into certain areas of the economy, and it also takes more time for monetary policy to work through the economy. But through fiscal policy, Congress can very strategically and very quickly put money into the hands of people in the United States. And Congress has been debating this. Unfortunately, over the last 2 days, Congress has failed to pass a fiscal stimulus bill in 2 votes on Sunday and on Monday. Congress failed to pass something. And so it is essential that Congress pass the bill as soon as possible and get the much needed fiscal stimulus that people need. If we can get that $2 trillion coming into the economy very quickly, it's estimated that the overall economic impact that we're seeing right now is about a loss of $3 trillion of income coming into the country. So if the Congress can very quickly step in and replace 2 of that $3 trillion, it can at least hold up the economy, keep people moving, give individuals those checks that they need, give businesses the grants or loans that they need, give our first responders and our hospitals the revenue they need, and give state and local governments the money that they need. We can at least keep the economy moving through. And so I'm really hoping that Congress will get that done in the next 24 to 48 hours. Looking regionally, it's even more difficult. There's even fewer of those big indicators. But what I'll just kind of focus on here is how our region looked and how the state looked, and how we kind of the economic circumstances going into this for the state of Utah. Going into this, Utah was the second fastest growing state in the country. Again, Idaho was number 1 at 2.1%. Utah, Nevada, Arizona all tied for second place. The West continues to be one of the hottest places to live. Everyone and their dog seems to be moving to the Intermountain West, which is it's been a struggle because you have to plan for infrastructure spending and growth, but it's a great problem to have, to be seeing a lot of population growth. When we look at the components of population change, this kind of shows how the growth in Utah occurs. We topped 3.2 million people in the state of Utah. Of that, 31,000 was from our own children and grandchildren. So that's something that's very unique to Utah, that we have this natural increase because of our own growth. And you can also kind of see that Utah has grown through periods of baby booms. In the 1960s, the original baby boomers And then again, in the 1980s, another group of boomers. And then in 2005 to 10, a third boom. Now, here's my prediction. In about 9 months, we're going to start to see another baby boom. Everyone's stuck in their houses now and producing a lot new per capitas to our population. In addition to that, though, we've got in the state of Utah over 20,000 people moving into our state on an annual basis. Now, I'm going to tell you right now that number is going to go down, because one of the impacts is going to be people are going to be less likely to move there as the economic situation becomes more difficult. People are going to want to stay where they are. So we'll see that number drop, and could potentially even go negative. But I'd point you to the net migration in the Great Recession, where it was a really tough time there. We saw slight out-migration from the state, but mostly what happened is we just kind of stayed constant. And that's what I would expect to see again, just because Utah, especially relative to other states, is in such a strong position. Looking at employment, heading into this, Utah had the highest employment growth in the entire country. And not just the highest, but the highest by a long shot. The nationwide job growth was 1.4%. Utah was 3.1%. So very strong job growth in the state of Utah. Idaho came in very close at 2.9%. And Texas also had really good job growth, in Arizona in the high twos. But Utah continues to be the strongest state in the country in terms of job growth. Where were we seeing the growth? Again, all sectors of the economy were growing, with construction on top at 9.5%, education and health also at 6%. What's interesting is I would predict that as we start to move into this new economic slowdown period, at least in the short term, construction will still be growing very strongly, mostly because a lot of the projects that were started before the downturn will need to continue to move forward and be completed. And also the impacts that we are seeing in areas like retail and entertainment and leisure and hospitality won't have that kind of impact on construction. Now, in the intermediate term to longer term, maybe a year from now, then we'll start to see a slowdown in construction as new projects are curtailed or possibly canceled. And then also we're going to see a big increase in health. Healthcare is going to be a big focus for our country, so we'll see those areas growing pretty dramatically. Looking at that unemployment rate, again, this is an area where Utah really shined. We have the lowest unemployment rate in the entire United States heading into this period at 2.3%. To put that in perspective, a year ago, Utah had a low unemployment rate, but we weren't even top 10 in unemployment, and it just kept sinking lower and lower and lower. Now, in the past, I kind of used this as a warning sign because Utah's unemployment was so low relative to other states. And also, on the next slide, Utah's unemployment rate was at its lowest level in history at 2.3%. Now, in normal times, and what we were starting to see was real problems with labor shortages, real problems with businesses being able to expand because of lack of available labor. Now I see it as a positive because as we start to see a big increase in layoffs, a bigger increase in people unemployed, we're tapping into a bigger resource that we will be able to hopefully absorb many of those people into new jobs. The struggle here, of course, though, is if the state of Utah sees a V-shaped recovery, we essentially return back to business before relatively quickly, maybe within a quarter or just a few months. But if we move into a U-shaped recovery, as people get laid off, they will start to move into new areas. They'll get new jobs. And this is where we start to see economic displacement, where those companies that fired or laid off people will have a hard time getting them back, because those workers are going to get new jobs. They're going to go into different areas, and it will start to cause a fundamental change in our economy. So one of the things one of the pieces of advice that I'm giving to businesses, especially businesses in highly competitive industries, is if you can avoid layoffs or letting people go, you should do it as long as you can, because in a market like this, it will be hard to get those people back once they're laid off. In addition, our economic fundamentals were really strong in terms of serving those underserved groups in our society. Utah had the third lowest poverty rate in the country, still has the third lowest poverty rate in the country. I expect that this will actually remain very similar. The rate will probably go up, but our relative ranking is very strong. Again, this is another area. A year ago, Utah had the sixth lowest poverty rate in the country, and now has dropped to the third. What that means is that the economic benefits are being felt widely throughout our society, and so and we have a greater ability than many to provide for those that are suffering and in need. And then Utah's overall, this is state GDP, was the second fastest growing in the country, behind only Texas. And the growth in our GDP was among the highest as well. So our fundamentals in terms of our overall economy were very strong. Utah growing 3.2% compared to 2.1% nationwide. So really strong growth in our economic fundamentals. And then home values were also, this is another area that that we had seen big increases, all-time highs in our home values, topping $350,000 median household price in Utah. Our previous high had been $260,000, and we're much higher than the U.S. average. I expect that this will come down. We will see big impacts in the real estate sector because of this. What we'll see is people just kind of slowing down their demand for new homes, slowing down their willingness to pay more for homes. Now, we're still going to see that population growth. We're still going to see that natural increase. And so there'll still be demand for homes, but at least in the period of greatest uncertainty, especially with the health uncertainty and economic uncertainty, we'll see people a little more reluctant to get that home, and those prices will have to be more competitive to pull those people in. We may see more people doubling up, families doubling up, or saying not forming new households in the same degree that they were in the past. And I would guess that as we move forward, we'll also see kind of a change in the type of home that people want. They'll want maybe less of the frills, maybe lower square feet, or the lower size, smaller size of the homes as we move into the next sector. Again, it all depends on the nature of the downturn and how quickly we recover. So that's kind of the general overview that we're looking at. It is a very uncertain time. We're early in the period. I'm going to be watching this really closely. I have regular updates from my contacts throughout the country, and as we get more data in, we'll be kind of updating these expectations and updating everyone as well. Thanks so much.
Okay, fantastic discussion today, Robert. Thanks for giving us some time. By far, one of our most popular speakers that we bring in front of our clients every year. This is our fourth year doing it. You've been a great asset to help us guide where we're leading our clients. Let's start off with just a couple questions. Maybe in addition to the data points you gave us, you can give us some information on a little bit on money supply, but tell us about financial strength of the different banking institutions and regionally and in Utah specifically.
Yeah, and that's, in times of uncertainty, that's always one of the fears that people have, is, is the financial system safe? Is the banking system secure? Are we going to have access to our money, essentially? You can have your money in the market, you can have your money in the bank, you can also have your money under your mattress, and which is never a good idea for any reason. Even if you've got low inflation, there's a lot of risk about putting your money under your mattress or in a safe. It can get stolen, it can get destroyed. The banking system. And we often look at our current situation compared to our last situation. So during the Great Recession, it was caused by fundamental weakness in the financial situation. We saw failure of big financial institutions like Bear Stearns and Lehman Brothers, AIG and Merrill Lynch. That is not the situation today. The federal government was very aggressive in helping shore up the financial services industry. Banks are much higher capitalized today than they were 10 or 15 years ago. Banks are in a very good financial position right now. So there's very little to no fear of banks having any kind of liquidity problems or any problems meeting their obligations. And then in addition to that, you've got the Federal Reserve essentially showing a complete willingness to give banks whatever they need to maintain that liquidity. So the Fed is injecting money through the discount window into banks to make sure that they have the money, the ability to work with their clients. That's something that Zions Bank is doing, and it's something that all banks are doing. They're either reaching out to their customers to talk to them about how their loans are going, if they need to defer, if they need to work with them, or if people come in that problem, they can also contact their banker and say, hey, can you work with me? And the answer is going to be yes. And then and then worst case scenario, if a bank were to fail, FDIC insures every person with money in the bank up to $250,000 per person per account. So there is very little fear of people losing their money in the overall financial system or the overall banking system.
Excellent. So turning to the budget side, now we have clients in many states, but obviously you're more familiar with Utah. So from a budgetary standpoint, I'm just wondering, with a prolonged downturn, if it does turn into a U shape or an L shape, what do you think the budget and fiscal status of the United States, how will that impact the overall recovery, and then also at the state level, state by state?
Yes, and I can speak to Utah more specifically, but Utah kind of as an indication of other states. And I don't know, do you want me to go top down or bottom up?
Go top down.
Top down. So let's talk about the feds.
Yeah.
And I think that's an important part of it. The federal government has similarly, especially through the Fed, said they will make sure that states have the resources they need to be able to respond. That again, banks will have the resources they need, but also states will have the resources, whether that's through emergency management, whether that's through the unemployment insurance program, through maintaining supply chains. A lot of people right now are worried. If you go to the grocery store, pretty much anywhere in the country, you're not going to find toilet paper and you're not going to find hand sanitizer. And that's just because there's a short-term disruption in some of those. But the important ones, like basic food products, the federal government will maintain those supply chains. They will. There are many options. President Trump has talked about invoking some of those to make sure that the healthcare system and our fundamentals stay in place. Similarly, you're going to see support for state government and for individuals from the federal government. That's a big part of that $2 trillion fiscal stimulus package as well. It's going to be a combination of giving people money directly, giving businesses money directly, and giving state governments money directly. When you kind of go down to the smaller level, Utah, the state of Utah was very well positioned heading into The Utah's legislative session ended just last week or just a week ago, and rainy day funds were actually full. There's a statutory limit on how much the state can have in rainy day funds. They were full. So once Utah filled up their rainy day funds, then they started adding in working rainy day funds, essentially taking ongoing money and setting it aside. So a typical rainy day fund is just one-time money. So it's money, kind of like cash in your pocket. Ongoing money is money that we have coming in from tax revenues that we can use for ongoing purposes. And Utah and many states has set aside some of that money as working rainy day funds. And then specifically with Utah, the state had about $80 million of extra money set aside to cut taxes going into this year. And about a month ago, we started to see signs that there was some trouble going on. And so Utah legislators took that $80 million and said, we're going to hold that back and have it ready to respond. And so, and a lot of states have done very similar things. The state of Utah is very well positioned for this. The legislature is, even though the session has ended, there are ongoing discussions, making sure that we have that we have things in place to be able to quickly respond and to help needed groups.
Excellent. Besides the indicators, like you mentioned, supply chain, and I think I've talked to people that is a big concern. Are we going to be able to get food and all the things that are happening? And putting people's fears to rest on those things, I think will go a long way. The other thing I was wondering about is, as we look at kind of moving forward, are there other key data points that are going to come out? Because right now we have so much speculation and fear. That's what's driving so much of this. We look to unemployment, and that's an obvious one. Are there other key data points that you see coming that will kind of give us a sense of where we really are, and when do you see those happening?
Yeah, on the health side, the critical one, excuse me, on the health side, the critical one is going to be when we start to see those numbers of new cases and number of deaths even out or start to go down. We've already seen that in China. We're seeing that in South Korea. And there's very, very early indicators. It's only 2 days of data, but in the last 2 days, the number of deaths in Italy have started to go down. Now, we don't know whether that's a short-term blip or whether it's a long-term trend, but if it turns into a long-term trend, we can start to see that in different countries. We're still 2 weeks behind Italy, so we're going to see a big increase over the next 2 weeks. So that's the health side. Once we start to see those numbers crest and start to go back down. On the economic side, again, it's really hard because we're looking way back to know what's happening with the economy. So the ones that I'm watching really closely are those unemployment insurance claims, like you said, but also that consumer confidence number. Once that number starts to bottom, we'll start to see that people are feeling better. They're getting more comfortable. Once we get people back to work, once we start reopening businesses, we're going to have to be careful because we still don't have a vaccine yet. We still don't have a FDA approved treatment yet. And we are going to see, some problems at hospitals and things like that. But once people adjust to the new normal, this could be several weeks or even a few months until we start to see this, then we'll start to see signs. Stock market is another one. Stock market is almost like a real-time indicator of consumer sentiment. And so I'm watching that really closely to see when we can see signs of that bottoming. There are some really good deals in the market right now. And it may be hard to identify those right now, but in a lot of areas, there are stocks that are on sale, and there are opportunities to identify those and jump into those. Excellent. But you guys are the experts on that.
Yeah. Make sure you have cash first. All right. One other question I had is just the overall direction of the Fed and monetary policy, because there's a conflict between the invisible hand of the free market economy, Adam Smith, and intervention. And so I've wondered if you think so far the Fed has done everything it should have at the right time. And I know this is an opinion. Yeah. We don't know the results of that yet. But what's your feeling or your sense of that, as well as are they tapped out?
Yeah. So, and I kind of look at things in two. Adam Smith is kind of like the father of economics. But if you look at the two polar opposites, you've got Milton Friedman and John Maynard Keynes. And we essentially just switched from Friedman to Keynes. So we're all Keynesian now. And again, and I should describe that. Milton Friedman was very hands-off, said let the private sector decide what they want to do. He wrote a famous book called Free to Choose. John Maynard Keynes, on the other hand, was an economist during the Great Depression that advocated government intervention and government support and government spending to support the economy. This is not a period. Now, I think there's appropriate times for each of those approaches. This is not the time for Friedman. This is the time for Keynes. And so I think the actions of the Fed have been very appropriate. I think the Fed stepping in and providing that support, providing that confidence in the market and in individuals is critical right now. There will be a time to go back to Friedman again, but now is not that time. There also is a valid concern about the long-term national debt and deficit. I mean, we're talking we're probably going to spend a total of $2 to $3 trillion, and which means that we're going to increase the national debt by $2 to $3 trillion because of this. And long-term, that is a concern. And that's something we're going to have to deal with. And it's something that I've been concerned about for a long time. But we're going to have to deal with that another day.
So last question. We've talked a lot about economic impacts of what's going on, especially with coronavirus and other elements that are naturally recurring as a cause of that. Let me ask you to put on your state legislator hat. Speak to us a little bit more about where we're at now and what return to work looks like. What would have to happen for the lift on restaurants and public gatherings to occur and people to return to as much of a normal life as the virus allows us to?
See, and that's one of the big questions we're trying to figure out right now. Is this, I mean, there is talk of a malaria drug being used as a treatment. There are clinical tests going on right now to provide a vaccine for the virus. And those have been, remember that we're actually 3 months into this, well, I guess you could argue even 4 months because it started in early December. So, there's been work on this for several months now, and there are potential breakthroughs going on right now. The hard part is going to be, when do we, reopen schools? And it could be 2 weeks. It could be not till September. And so, we don't really return back to normal until then. We reopen businesses, but there is going to be this kind of lingering fear of people to be in tight spaces. When will people want to go on cruises again? When are they going to want to go on trips again in airplanes? It's hard to answer that. And I think some of those impacts are going to be longer term. It could be several months to a year until people really have that confidence to get back there. But we've got to, as quickly as is feasible and safely, we've got to get back to as much normalcy as we can, because it is vital to the health of all of our financial lives to kind of return to this. And in some ways we'll just have to adjust to the new normal, but it is important for us to as quickly as we can restart the economy, get everyone back to work, and get everything moving again.
Awesome. Thank you.
Robert, thank you for coming and sharing your insights, your expertise, and your background. It really is really relevant for right now and really much appreciated, not just by us, but all that will see it. So
thanks so much for having me. I appreciate it.
You bet.
Thank you for listening to The Wealth Advocates. Join us every month by subscribing on Apple Podcasts, Spotify, or Google Podcasts. You can also look for The Wealth Advocates on Stitcher and YouTube. Want more information about today's topics? Reach out to John or Patrick directly by calling or texting the Wealth Advocates office at 435-754-6600. 7888. Learn more about the Wealth Advocates and how they can help you by visiting wealth-advocates.com. Securities offered through registered representatives of Cambridge Investment Research Incorporated, a broker-dealer member FINRA, SIPC. Member FINRA, SIPC. Advisory services offered through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Wealth Advocates and Cambridge Investment Research Incorporated are not affiliated. Thank you for listening to the Wealth Advocates.